This presentation is for Chapter 13, Current Liabilities and Contingencies. In this chapter, we will cover the nature, valuation, and reporting of current liabilities. Many of these topics you will be familiar with from your previous accounting courses. We will also cover classification issues associated with short-term debt that is expected to be refinanced in the period following the current reporting period. In the second part of the presentation for this chapter, we will cover gain and loss contingencies and presentation and analysis of liabilities and contingencies. In the first learning objective, we will discuss the nature, valuation, and reporting of current liabilities. On this slide is the definition of a liability. We often skim over definitions, but they are an important tool that is used in accounting to determine what is and isn't a liability. There are certain criteria that must be met in order to record an amount as a liability. One is that there must be at least a probable chance that the amount will be due in the future. Also, in order to record the amount in the balance sheet, it must be a present obligation, and the event that created the liability has to have already occurred. We will see in the discussion of loss contingencies that this definition is critical to the determination of whether or not we record, disclose, or ignore an event. If you remember from your previous accounting courses, current assets are those that we expect to convert into cash, sell, or consume in our operations within a single operating cycle or within a year. This definition is important in classification of not only current assets, but also current liabilities. As we can see, current liabilities are those that will result in the use of current assets or the creation of other current liabilities. It is important to note that not every business has a short operating cycle. Some, like a whiskey distillery, may have an operating cycle that extends over many years. Or a restaurant may have a very short operating cycle because the food may be purchased the same day as the meal is prepared and sold and the cash received. Therefore, we normally set 1 year as the cutoff for current assets and liabilities, but if the company has a longer operating cycle, the definitions allow for a longer period of time. This slide shows the typical current liabilities that you will encounter, and these are the ones that we will be discussing in this presentation. Many of these you will already be familiar with, but some of this information may be new to you. Accounts payable, or trade accounts payable as they are commonly referred to, are the balances that a business owes to its suppliers for goods and services purchased on account. A company will generally have an open account with its suppliers that will allow it to order items or services as needed and have the goods delivered or services provided, with payment due generally in 30 days. There may be discounts that are given for prompt payment as noted in the terms of the sale, such as a 2% discount if the amount is paid within 10 days of the invoice, or the amounts may be due in 30 days or by the end of the month. Notes payable are more formal than accounts payable because they are written promises to pay a certain amount at a specified future date. Usually these notes arise from either purchase or financing transactions and can be either short or long term. Most of these will be for larger amounts, which is one of the reasons why they require the more formal process of being in writing, and they will either have an interest rate stated or they will be discounted notes that are also called zero interest bearing. In this slide, we will record an interest bearing note payable. Castle National Bank agrees to lend $100,000 on March 1, 2020 to Landscape Company. If Landscape signs a $100,000 6% 4-month note, Landscape records the cash received by debiting cash and crediting notes payable for $100,000. If Landscape prepares its financial statements at the end of June, it would accrue the interest on the note for 4 months, March, April, May, and June. To determine the amount of interest, you would multiply the principal, $100,000, times the annual interest rate of 6%, and multiply by 4 divided by 12. This gives you the interest of $2,000, and you would record this by debiting interest expense and crediting interest payable for the $2,000. The note payable would actually mature the next day, July 1st, and Landscape would debit notes payable for the principal of $100,000, debit interest payable for $2,000, and credit cash for the total amount due of $102,000. We will look at this same note, but instead of having an interest rate of 6% on the note, this note is a zero interest-bearing note or a discounted note. On March 1st, Landscape issued a $102,000 4-month zero interest-bearing note to Castle National Bank. To record the note and receipt of the cash, Landscape would debit cash for $100,000, debit discount on notes payable for $2,000, and credit notes payable for $102,000. The discount on notes payable will be the interest expense for the note. The note payable would be shown net of the discount on the balance sheet as we see in this slide. The discount on the note is a contra account to notes payable, and as we mentioned, it represents the cost of borrowing. It will be amortized to interest expense over the life of the note. Another common current liability is dividends payable. Dividends are amounts that are owed to the common shareholders once they are authorized by the board of directors. Because they are generally paid within a short period of time from the date of declaration, they are a current liability. As the slide notes, undeclared dividends on cumulative preferred stock are not recognized as dividends. They are disclosed in the notes to the financial statements. Stock dividends are additional shares of stock and are reported in stockholders' equity. Companies may require that customers pay a returnable cash deposit to guarantee performance of a contract or service, or as a guarantee to cover payment of expected future obligations. You may have been required to pay a deposit when you rented an apartment. These deposits can be either current or long-term liabilities based on the time period of the contract. Many companies require payment prior to the delivery of goods or services. The amounts that the company collects prior to performance are recorded as unearned revenues until the company satisfies its performance obligation. Some common examples of unearned revenues are shown in this slide. When the cash is collected, the unearned revenue is credited, and then when the performance obligation is satisfied, the unearned account is debited and the revenue account is credited. For example, if Allstate University sells 10,000 season football tickets for $50 each for its 5-home game schedule, the university would debit cash for $500,000 and credit unearned sales revenue for the same amount. As each game is completed, Allstate would debit unearned sales revenue for $100,000 and credit sales revenue for the same amount. Retail companies that sell goods are responsible for collecting sales tax from their customers. These amounts are not expenses of the companies, but rather are payments that they collect and then remit to the proper governmental authorities. Since they are usually due in a relatively short time from collection, they are considered to be current liabilities. This slide illustrates the recording of sales tax. If a company makes a cash sale of $3,000, which is subject to a sales tax of 4%, they would need to collect the sales tax of $120 from the customer. To record the sale, they would debit cash for $3,120 and credit sales revenue for $3,000 and sales tax payable for $120. Some companies may not segregate the sales tax when they record the sales transaction. If this is the case, they would need to determine the sales amount and then debit sales revenue for the amount of sales tax collected. If a company recorded $150,000 in sales which are subject to a 4% sales tax rate, they would divide the $150,000 by 1.04, and this would give the amount of sales, $144,230.77. The difference between the $150,000 collected and the $144,230.77 of sales is the sales tax of $5,769.23. To record the sales tax payable, the company would debit sales revenue and credit sales tax payable for the $5,769.23. Another common current liability is income taxes payable that the company owes on their own income. Companies are required to make periodic estimated tax payments throughout the year to taxing authorities. These amounts are then used to offset the income taxes due when the tax return is prepared for the year. Any difference between the income tax payable on the return and the estimated tax payments made would be a current liability. Frequently, there are timing differences that result from differences in income tax laws and accounting income recorded using GAAP, and we will cover these in Chapter 19 later in the course. Employees are owed salaries or wages that are reported as current liabilities, as well as the amounts that are deducted from their pay. Also, any amounts due to employees based on compensated absences and bonuses are accrued and reported as current liabilities. The most common types of payroll deductions are taxes, insurance premiums, employee savings, and union dues. There are two components of the Social Security tax. One of the components of Social Security tax is the Federal Old Age, Survivor, and Disability Insurance, or OASDI tax, that provides benefits for certain individuals and their families. This tax is levied on both employers and employees. The rate is 6.2%, and there is a cap of $137,700 as of 2020. The OASDI tax is often referred to as F.I.C.A. The other portion of the Social Security tax is the Medicare tax that provides federal health insurance to the aged population. This tax, like the OASDI, is levied on both the employer and the employee at a rate of 1.45% of the employee's compensation, but there is no income cap on this portion. Together, the OASDI and federal hospital insurance taxes are referred to as the Social Security tax. The federal unemployment tax, or FUTA, is levied only on employers. The rate is 6% of the first $7,000 of compensation paid to each employee during the calendar year. If the employer is subject to a state unemployment tax of 5.4% or more, the employer receives a tax credit not to exceed 5.4% and only pays 0.6% tax to the federal government. Most states grant discounts to employers based on their history of unemployment claims. Even if the employer receives discounts such that it does not pay 5.4%, the employer will still receive the full 5.2% credit toward the FUTA. Thus, an employer could pay the state 4% unemployment tax and still pay only 0.6% to the federal government. The states have various compensation laws that differ from the federal law, and employers must refer to the unemployment tax laws in each state in which they pay wages and salaries to determine the proper amount due to the individual states. Employers are also required to withhold income taxes due for state and federal taxes from their employees' pay. These amounts are in addition to the F.I.C.A taxes that we just discussed. The employer will match the F.I.C.A taxes for their employees and also pay the state and federal unemployment taxes that are due. To illustrate the payroll deductions that we have just discussed in the previous slides, this slide shows the journal entry for a weekly payroll of $10,000 that is entirely subject to both F.I.C.A and Medicare taxes at 7.65%, federal unemployment at 0.6%, and state unemployment at 4%. The income tax withholding is $1,320 and union dues $88. The journal entry includes a debit to sales and wages expense for $10,000 for the gross pay and credits to withholding taxes, F.I.C.A, and union dues, and then cash for the net pay of $7,827. We also need to record the employer's payroll tax expense for this same payroll. Remember that the employer must match the employee's F.I.C.A tax of $765. The federal and state unemployment taxes are also due as shown for a total of $1,225. The debit for this entry is to payroll tax expense, and the credits are shown for the F.I.C.A, F.U.T.A, and S.U.T.A. As we mentioned before, employees are often compensated for absences for vacation, illness, and holidays. Whether the company needs to accrue for these absences depends on whether they vest or accumulate. To vest for a benefit means that you will be paid for them when you leave employment. To accumulate means that the benefits carry over from one period to the next. Most vacation days accumulate up to a certain amount and vest. However, many sick leave benefits only accumulate to a maximum amount but do not vest. If the benefits do not vest, then the employer would need to determine if it is probable that the benefits will be used and also if the amount can be reasonably estimated. Since sick leave is based on whether an employee gets sick, some companies do not accrue sick leave. But because vacation pay usually vests, most employers will accrue an expense and liability for vacation pay. To illustrate recording for compensated absences, we will consider the case of Omicron Inc., which has 10 employees and pays each one $480 per week. Employees earned 20 unused vacation weeks in 2020. In 2021, the employees used the vacation weeks, but they earned $540 per week. In 2020, Omicron would record the salaries and wages expense for the vacation pay by debiting salaries and wages expense for $9,600 and crediting salaries and wages payable for the same amount. In 2020, when the employees take the vacation, Omicron Inc. would debit salaries and wages payable for the $9,600 accrued and debit salaries and wages expense for $1,200. The difference in the pay now that the employees are earning $540 per week, and credit cash for $10,800. The $1,200 difference is considered to be a change in estimate. Omicron Inc. made the best estimate of the amount of salaries and wages expense in 2020 when they accrued the $9,600. Bonuses are another example of an employee-related liability. Bonuses are required to be recorded as an operating expense in the period in which they are earned. These are normally current liabilities because they are not paid until the next period. To illustrate the recording of a bonus agreement, we will assume that Palmer Inc. had income of $100,000 and bonuses due of $10,700 for 2020, which they paid in January 2021. To record the bonus expenses, Palmer would debit salaries and wages expense for $10,700 and credit salaries and wages payable for the same amount in 2020. When the bonuses are paid in 2021, they would debit salaries and wages payable and credit cash for $10,700. When long-term liabilities mature within the next fiscal year, they become current liabilities if they require the use of current assets or the creation of a current liability. However, if the long-term portion maturing will be paid out of assets that are not current, refinanced, or retired from the proceeds of a new debt issue, or converted into capital stock, they may continue to be classified as long-term. In this learning objective, we will cover the classification issues associated with short-term debt expected to be refinanced. When short-term obligations are refinanced and the liability is contractually due to be settled, and the entity has a contractual right to defer settlement of the liability for at least 1 year or the operating cycle after the balance sheet date, then the obligation can be excluded from current liabilities. To illustrate this, we will consider the scenario involving Montaven Winery, who issued a note payable of $1 million on November 30th, 2020. This note is due on February 28, 2021, and the balance sheet date is December 31st, 2020. The financial statements are issued on March 1st, 2021. However, Montaven plans to extend the maturity date on the loan to June 15, 2022. Now we will consider the classification of the note depending on whether the refinancing is completed on January 15, 2021, or if it is completed by December 31st, 2020. If the refinancing is not completed until January 15, 2021, the note would be classified as short term. However, if it is completed by December 31st, 2020, it would be presented as long term rather than short term. And this is the conclusion of the first part of the presentation for Chapter 13.